So I'll just flick back before we get into the question to the title slide there, and you'll see it's got a bit of a festive sort of Halloween feel to it. That's because we released these economic forecasts a few weeks ago on Halloween. So we went with that branding, and we also kind of went with the theme trick or treat. And that seemed pretty apt to us because there's a few things that are changing in the economy right now. Some that have the potential to kind of deliver some perhaps not so great outcomes, perhaps a bit of a trick, but also the potential that we could be looking forward to better times at some stage in the future and potentially lower interest rates as well, which would certainly be a treat. And you never know what this new government, when we eventually get this new government, will deliver you. Could be a bit of both depending on who you are. So as advertised, I like to make people sing for their supper a little bit here, and I always have a few questions as we go through. The first one I've got is, do you expect the economy to be in recession by the end of this year? So basically that's really asking you, do you think we're in recession right now? Recession generally advertised as a couple of negative quarters of growth in a row. Tell us what you think. Just looking on here, it looks like we've got 90 odd votes so far, and we'll go into the results here. And okay, so it looks like there's a pretty optimistic crowd, I think, in Auckland. I've been asking this question around the country the last few days. Bit more pessimism in Wellington right now, be fair to say. They were probably a bit closer to 50-50. Christchurch is actually quite bouncy though. They probably, I'm just trying to remember what that proportion was, might have been over 70% actually positive. And that's quite interesting actually, because there's a range of views out there about exactly how badly the economy is doing right now. The Reserve Bank, for example, envisages that we're actually in a recession right now. We'll basically be sort of like in the middle of this period of two or indeed 3 quarters of negative growth. For our part though, we're a bit more optimistic. So if we think about the economy, we're basically seeing ourselves in the process of a deceleration of growth coming from a relatively robust period of growth through that COVID period. One of the kind of issues during the COVID period is there were great concerns that there was going to be a large hole open up in the economy from the significant health emergency and the kind of policy consequences that were taken to try to ameliorate those concerns. A lot of kind of fiscal and monetary stimulus was thrown at the economy to try to fill in that hole. That hole didn't really emerge. So as a result, we actually ended up with some pretty decent, albeit volatile growth outcomes through that pandemic period. And it unfortunately left us with that legacy of imbalances that I was talking a lot about when we did this last update a few months ago, and inflation being the sort of one of the most prominent imbalances that's bothered everybody, businesses, households alike. So we've been going through this period for a couple of years now where the Reserve Bank has hiked interest rates really significantly, 525 points, hasn't really been seen in the OCR period or through most of the inflation targeting period really. And the consequence of that now is we're in that period of slowing growth. We're basically anticipating that over the next few years, growth will be averaging a bit below half of what we got used to for the 10 or so years after the GFC. And that is below the potential capacity of the economy. So as a result, the excess capacity is gradually being built up, and that's what's doing the work to ultimately restrain inflation. So in terms of the shorter term growth profile, and getting back to that kind of question that we posed at the start, are we in a recession now or not? Our forecasts are that there isn't actually a recession in play here now. Nevertheless, we don't have very much growth in the forecast. We've basically got fairly flat growth for the next few quarters or so, and a gradual improvement as we get through the back end of next year and into the year after that. But it's fair to say we're definitely flirting with recession. The statistician's pen is pretty thick when you're getting down to these sort of numbers. It's not entirely, it's totally plausible that we could actually end up measuring a small recession at this stage. But there is also the possibility we skate through this with some relatively low single-digit growth numbers as well. So what's going on here that's really engineering how we're seeing things pan out in this relatively weak growth outlook over the next while? I mean, it's the lagged effect of those significant interest rate rises I was talking about. And, one of the things that with respect to New Zealand households is that they do get a bit of time to basically adjust to increases of the official cash rate in the wholesale markets because most of us have got a fixed term mortgage. So, we think that the households are a fair way through that adjustment process, but there's still a fair bit to go. There's probably still another 100 or so points of extra cost that have to go into household budgets. And what that's doing is really restraining the interest-sensitive sectors of the economy, and will do for a good while yet. If I think about some of those particular interesting negative interest rate sectors, we can see it really prominently in the business sector, where some of those kind of PMI kind of like indicators, PSI indicators are telling us that businesses don't perceive a very strong growth environment at the moment, could even be consistent with a recession. We really do see it in retail spending, which has been really weak in nominal, but especially in real terms for a while. And that's just that impact of all of those extra costs that households are having to deal with in terms of higher interest rates, leading to belt tightening throughout their budgets, and as a result, reduced spending on retail goods and services. It's also quite apparent in the construction market and building more generally. So one of the things that we tend to see in the construction market is that it lags trends in the housing market by a while. So what we're kind of seeing now is that because house prices were falling in nominal and particularly in real terms up until about the middle of this year, what we're now seeing is that dwelling consents are coming off a bit. The pipeline of new work coming through in the construction sector is gradually running dry, and we expect to see that reflected in terms of less GDP coming out of the construction sector over the next year or so before ultimately things improve later on as we see house prices, the effect of stronger house prices percolate through into that part of the economy. But nevertheless, for the balance of this year and for most of next, we're not expecting very much out of that sector. So, I've been telling you, perhaps you could even interpret it as a relatively positive story, really, and that I'm not saying that we're in recession, but nevertheless, there's still plenty of indicators out there that feel really recessionary. A good example is consumer confidence, for example, which is basically at near historic lows. And the reason for that is that even though kind of like the absolute level of GDP is still going forward, on a per capita or a per person basis, it isn't. And in fact, it does look quite recessionary when you evaluate it in those terms. Everybody's share of the GDP pie is just getting a little bit smaller, basically, because we've got relatively low but nevertheless positive growth, but we especially have a much strongly growing population, so hence the sort of ratio between those two things is going south. Not as far south as it would do in a very bad recession. You can sort of see those historical examples like back in the GFC, for example, even through the bottom of the COVID period where it was much worse than it is now. But it's certainly not a very strong picture, and hence, I can totally understand if as an individual you would sit there and look at the situation and go, well, I don't understand why he's not saying this is not a recession, because it totally feels like one. So what's the thing that's really kind of helping take the edge off the economy in terms of the absolute level of growth? And it's that really strong inward net migration been talking about now for about 6 months. It's only been getting stronger. So, a few months ago, 6 months ago when we first started talking about this, we were saying, this has bounced back quite strongly, don't know how long this is going to last. Well, it's turned out it's lasting for at least as long as we thought before, and it's coming in stronger than what we thought before as well. It's at 119,000 people net coming into the country in a 12-month period. That's never happened before. Big turnaround, obviously, from the 20,000 people leaving a year or so ago. It's driving population growth, well into the sort of mid-twos range, which we haven't seen since the 1960s. And the reality is that when you got that much population growth, that much more kind of like labour supply coming into an economy, it generates output, it generates growth. That's why this economy is still going forward, even though the interest rates have gone up quite a bit and things generally look pretty weak in those sectors of the economy that are quite interest sensitive. But one of the things that we've done in this round is that we've had to upgrade our forecast for how strong we think net migration will be in the next little while, because the history has continued to come in ahead of expectations. We still anticipate that on an annual basis that's going to peak in the next month or two. But given the size of the growth, we have upgraded our medium-term profile. So we think there's going to be a decent amount of population growth coming through this economy for the next couple of years, which has particularly medium-term implications for growth and ultimately some inflation pressures. Thinking about the kind of like composition of what's going on with this migration, as I said, there's these very strong, unprecedented inflows of foreigners, but there's actually also similarly very strong outflows of New Zealanders. You can see it there on that red line where we're definitely at a cyclical high. And the story I want to tell you there is that both of these lines have really been driven by the very unusual factors that impinged on people's ability to move through that COVID period. So the foreigners are coming here because they've finally got that opportunity, or they feel confident that it's okay to kind of move to a place where they think there's better opportunities. And similarly for New Zealanders who perhaps would have gone overseas and done something in the last few years, they're getting on with doing it now. I know there are some commentators out there with a more negative take, telling stories about, New Zealand's too expensive, we don't grow very fast, the wages are not high enough, cost too much, etc., etc. I don't know if that's actually really consistent with the data we've got here. It's probably more likely that there's probably 3 or 4 years of people who couldn't go anywhere and are now going somewhere. It might also be consistent with the average age of the migrants that we see, like the people coming in and the people going out. The average age of them has actually risen by about 3 years. So it actually looks suspiciously consistent with just the fact that everybody put their lives on hold for 3 years because you had to. In terms of who's coming in, because that's kind of critically important to the skills mix that we're getting out of this. A lot of these people are coming from Southeast Asian jurisdictions with relatively low per capita incomes. And I would say for most of these people, they would say that living in New Zealand in a recession would probably be better than living where they were in a good year. So hence, to the extent to which they've got that visa and they've got that ability to come, there's every reason to believe that they will come and will keep coming for a while yet. Certainly if we look at the amount of visas that have been issued over the last few years, we see there's a heck of a lot more of them that have been issued than people turning up. So there could be a decent pipeline still coming here to come. But one thing we do note is that they're not coming from particularly wealthy jurisdictions. So hence, there's been a bit of chat out there about, well, maybe this migration cycle won't be as powerful effect on the economy because they're not bringing that much money with them. It's probably true. They're probably not buying mansions in St Heliers or Remuera. They're probably renting something in another part of town. But nevertheless, they're all doing something here. They all need somewhere to live. You can see the sort of indications through the economy that that's having that sort of impact. I'll talk to you a bit about the housing and the rental markets in particular, which kind of give a fairly clear idea on that. And there's such a lot of them as well that it really is having that kind of macro impact. And they are adding desperately needed skills into the economy. This is sort of like a list of the top 20 occupations from people that have been issued visas in the last year. And what you tend to see is a pretty decent correlation between those occupations and the areas of the economy where they were really struggling to get work. Particularly in food services, restaurants, nurses, there's teachers, engineers, the list goes on like that. And that's why they're here basically. They're coming here because there are opportunities, or at least there have been opportunities, and as a result they want to take advantage of those. That's adding valuable supply of labour into the economy. That's helping balance the labour market up better than what we saw during the COVID period, where people are really scratching around to try to find workers. But it's also adding a bit of demand into the economy as well. So one of the areas that's a real bright spot in this economy, and it is very related, I think, to what's going on with the population, is in the housing market, which is definitely stabilised and is rising. It's not roaring away. We don't have a housing market boom here at the moment, but it's certainly defied expectations of further weakness that you would have seen prominently in market forecasts for the house prices if you looked sort of like more towards the early part of this year. And it is happening all across the country as well, so it looks fairly broad-based. And, you know, for our part, we see that trend upward in house prices continuing. We think the house prices will go up about 8% next year. We see that as consistent with the lagged effect that you often see between increases in net migration and house prices. And you can kind of get a sense of that relationship through history there. We don't think we've got a particularly strong kind of like housing market response coming from that factor, particularly given the size of the inflows we're seeing. There's plenty of room for risk and for changes in that forecast as we see how things go over the next year or so. But it's certainly the case that, you know, right up until now, I think what we've seen is a lot of New Zealanders already living here who are sitting on the sidelines of the housing market for the last couple of years and prices are falling, are now deciding to get in because they're seeing the prices go up again now. They've had decent nominal income growth. The labour market participation rate is at record highs, so there's plenty of people working and they've got some resources to get into housing. Perhaps next year we'll see those joined by perhaps some investors, depending on what the new government does with respect to some of those investor housing rules. And also the potential that, you know, next year or so we should start looking forward to interest rate cuts as well. And that's something that could provide a bit of an extra stimulation as well to that market. The other thing I'll say about the housing market, which is quite interesting, is that we're coming into a juncture which probably is going to mean there's going to be a bit of an imbalance between the supply and demand of housing. So during the pandemic, we actually had it's a pretty good outcome for the housing market in that we built quite a few houses, but the population wasn't growing that much. So the net supply of housing was actually improving quite a bit through that period. And that's probably one of the reasons why house prices started to fall quite significantly a couple of years ago. That's totally turning around now, right? So I showed you before the chart of the construction sector, which suggests that the inflows of new housing is going to be coming off quite a bit in the next 18 months or so. And also you can see the demand coming from the population, which we expect to persist for a while. Less supply, more demand. You don't have to be much of an economist to work out what that might mean for prices, right? The other bright spot that we covered in a special topic in the QEO was tourism sector, which is also benefiting from this kind of post-COVID period where people couldn't do a whole lot of the sorts of things they wanted to do. Coming to New Zealand on holiday was one of those things, and they're really getting back into doing that now. We're probably about 85% or so away from the peak that we got to before COVID. Most jurisdictions, inward-bound tourism has recovered quite a bit. The Chinese have been a little bit slower, but the forward bookings certainly suggest that we should be having a pretty good period in the tourism sector over the next 3 to 6 months or so. Quite a good indicator of that is the airline capacity that we can kind of see that has really come on. There's a lot more flights coming into the country now, and we expect that because those flights are coming in, the airlines are expecting to put bums on seats. So that's probably good news for those parts of the country, particularly leveraged to that. And I saw this chart a couple of weeks ago I thought was quite interesting. This is a very long-term survey that the Conference Board does in the States on the attitudes of US people to travel overseas. And you can see there that, you know, this is the record number of people in the US looking to make an overseas trip in the next 6 months. And they're not all coming to New Zealand, but they don't all have to come here before we end up quite busy. And there might be a reason why you see all of these new flights coming in from North America to New Zealand over the next 6 months or so. The US economy in particular is one of those jurisdictions where the consumer is still doing pretty well. So if I look across the nation, I sort of see that there's some pretty divergent experiences depending on sort of like where you're living. Those parts of their country which are maybe a bit better leveraged to the tourism sector look like they're having a brighter time. We sort of did this analysis in the context of our new regional roundup that we released about a month ago. Places like Otago, Southland, Canterbury to some extent, kind of like leveraging from that. We also see that areas like Auckland doing a little bit better than average because we're the beneficiaries of a lot of the inward migration, at least for a start. And some of those parts of the country recovering from the cyclones earlier in the year are also looking forward to better times as well. And you can see that reflected in the retail sales in the likes of Gisborne, for example. So, you know, it really depends on where you are. Better in some places, weaker in others. Wellington, for example, relatively depressed at the moment. Certainly the crowd I spoke to yesterday was in a fairly sombre mood. So, getting into the next question, what do you think that wage growth is going to do over the next year? Do you think it's going to be above 5%, and it's kind of been running at about 5.7% in the last 12 months? I think it'll be between 3.5 and 5, or even lower than that. It's one of those things that's going to matter quite a lot for particularly the evolution of inflation over the next while. So let's have a look at these results. Fairly encouraging, I say. People not really anticipating that wages are going to be going up any more strongly than they have been, which is good. In fact, a decent proportion of people expecting them to come off quite a bit. And if I show you my forecast for that, you'll see that we would agree with you in general on that. We're basically anticipating that with all this extra labour supply, but also weakening demand in the economy, that this unemployment rate is going to drift up a bit. It's going to head up to sort of towards 5.5% over the next year at 18 months or so. And a consequence of that is we would expect to see wage growth come off. Coming off quite high levels now, high levels currently running much higher than would be consistent with inflation in that 1 to 3% target range. But we do anticipate that that should come off over the course of the next year, year and a half or so, and ultimately help support that move down in inflation eventually. So I guess it looks like our forecast there probably isn't too inconsistent with the sort of view I see around this room. And I would say when I've asked that question elsewhere in the country, there is that similar sense that wage growth should be coming off in the next 12 months or so. So New Zealand's a trading nation. The external sector matters quite a lot for sort of how we think the economy will go. And in that regard, things are not looking that flash. You know, we've basically still got a very weak global growth outlook going on out there. Pretty much, you know, the weakest outlook that I think that we've probably seen globally since the GFC. You know, basically most economies in the world are grappling with similar issues that we're grappling with here. A legacy of high inflation causing higher interest rates, tighter monetary policy, in some cases tighter fiscal policy, and a period of below-trend growth. So that's what it is, and that means it's a relatively tough period for our exporters to be out there selling things to the world. I guess one thing that's made us particularly concerned about some downside risks here is with respect to what's going on in China. China was supposed to be the jurisdiction that was the bright spot this year and into next because they opened the gates after COVID a bit later than everyone else. But it's turned out to not be the case. What has instead happened is that forecasters have been consistently underwhelmed with the outcomes of the Chinese economy. And indeed, next year they're forecasting that Chinese growth will even disappoint the 5% growth target that the Chinese authorities have for GDP growth over the year. And, you know, in an economy like China, growing at 4 or 5% is not a great outcome. I know, as a New Zealander, you're sitting there going, oh, this sounds like a pretty good year. In China, that's actually quite a bad year. You know, they probably need to grow at 6 just to kind of keep up with the new supply of workers coming into the economy. And as a result, you shouldn't be surprised when I tell you that, you know, the unemployment rate in China is really high at the moment. Youth unemployment is somewhere north of 20% right now. And whilst there's inflation everywhere in the world, the one place there isn't any inflation is China, which actually has deflation at the moment. So that tells you that there's something going on in China which isn't good and is certainly very different than the rest of the world. What this means for our outlook is that given that they're such an important trading partner, particularly in the primary sector, that most of our commodities prices are not going to be particularly strong over the course of the next year. In the case of the dairy sector, you can see there that we've got a forecast of $7.25 for the payout, which is quite a bit weaker than it has been for the last couple of years. And more generally amongst commodities, we see that weakness in China reflected through the basket. So particularly in meat prices, for example, log prices are very, very weak. 80% of our logs go to the Chinese construction market, and the Chinese construction market is the epicentre of where the weakness is in China right now. Overall, when we look about our forecast for commodity prices, we just see a relatively shallow bounce back in commodity prices occurring over the next couple of years. So we don't really think that for the external sector overall that things are going to be particularly good. And as a result, whilst our current account deficit should continue to improve from the really wide levels it got to last year, it's going to improve principally because we're growing below trend, and as a result we'll suck in a few less imports than we suck in when the economy's doing better. The reality is that we don't think this current account deficit will improve much beyond about 4 or 5% of GDP, which is on the wide side even by New Zealand standards. So with respect to the inflation outlook, that's really what's kind of key here for working out what we think interest rates are going to do, which brings me to the next question. Key part of the job that we have here, what's going to happen with inflation? When will CPI inflation reach the Reserve Bank's 1 to 3% target range? When do you think? There's a few sort of like options here to pick from. End of 2024, sometime in 2025, or even a bit longer. Tell us what you think. There's a bit of a split around there. So there's a bit of pessimism there really. Q3 or Q4 2025 is the biggest number. A relatively few people thinking that it's going to be within the target range by the end of 2024, which is quite interesting. I'll tell you a little bit about what our forecast and what the Reserve Bank's got to say on that matter. I think they would be a bit disappointed, to be honest, in these results. And I will say that these results are not actually inconsistent with what the rest of the country is saying as well, which perhaps they might want to take account of when they think about interest rates next week. What we've seen so far is that certainly headline inflation has come off quite a bit from the highs. And it's largely reflected improvements in the price of imported goods. And a lot of that has come through from the improvement in prices that has come through from the relaxation of all those supply constraints that we had during the COVID period. It's easier to get a shipping container around the world now. And also commodity prices have generally fallen quite a bit since the heights that they reached after the Russian war, for example, even though we've had a bit more volatility in oil prices in the last few months or so, as things have really kicked off again in the Middle East. The interesting thing though is that those falling kind of goods prices, the imported prices and food prices to some extent, those are all the kind of like easy yards in the inflation fight, because most of those things aren't really that affected by interest rates or domestic monetary policy at all. They're a reflection of what's going on out there in the world, pretty much. And I would say that, you know, all around the world, I could probably draw a graph like this for pretty much any country where they're all seeing the benefit of lower food prices and lower imported goods prices. But it's in the services sector where inflation remains very strong. And that's why I was asking you before about the wages, because wages are the key input into the services sector, and it'll be slower wage inflation that eventually lays down the ground for ultimately a fall in core inflation and services prices back down to the sort of levels they really need to be at, quite a lot lower than where they are today, for inflation to be back in the target range. And indeed, in New Zealand, what we see here is like a lot of those core inflation measures I'm talking about, and in Economist speak, we talk about non-tradable inflation, domestically generated inflation. Those indicators are either only slightly off their peaks or still peaking, depending on which one you look at. Most of the quarterly core inflation measures I look at are probably running 0.5% to 1% a quarter stronger than where they would need to be if you're going to have inflation at around 2%. which is massive, really. And the interesting thing is that so far, at least, they've actually not shown very much signs of deceleration. So that gives you pause, because usually we think of those sorts of inflation pressures as being quite persistent. They don't just turn around on a dime in a quarter or two and just disappear. They usually take a period of tight monetary policy to turn the economy around and bring those prices down. So hence, when you look at our CPI projections, we've got a relatively pessimistic view, certainly compared to the Reserve Bank, about just how fast that adjustment in CPI inflation is going to be. I mean, our forecasts basically have it back inside the target range, start of 2025, maybe early 2024, given some of the most recent falls in food prices we've seen. But it's obviously relatively pessimistic to the Reserve Bank, which has had this relatively fixed view that in the third quarter of next year, inflation will be back below 3%. It's obviously a bit more optimistic what I'm hearing from the crowd, though, which is quite interesting. And in the end, it's actually the crowd's view that matters here, because that's the people that are operating in the economy, buying goods and services, asking for wage rises, etc., etc. We certainly think it's going to be a good long time before inflation gets to 2%. That's a good long while. So as long as we've kind of got that sort of outlook, the scope for interest rate reductions is pretty modest. So this graph here kind of gives you that story I was telling you about easy versus hard yards. The easy yards, the pink line, the kind of tradables, the imported stuff, that's coming off fast, probably actually coming off a bit faster than what we might have thought even a few weeks or so ago. But it's that red stuff that really needs to be brought down, and that's the stuff that's still peaking, needs to show some fairly decent near-term signs of disinflation before the Reserve Bank can be very comfortable that they're going to be able to have this job done. And hence, if you look at our forecasts, we've got forecasts where there's still a chance of a rate rise early next year. To be fair, it's fairly finely balanced these days. I mean, some of the data we've seen in the couple of weeks since we finalised these forecasts showed that food prices and international airfares in particular came off quite sharply in the most recent monthly data that they started releasing. We think that probably would make the Reserve Bank comfortable that they're in no hurry to have to adjust interest rates certainly up further. Markets, on the other hand, are speculating that interest rate cuts might be coming perhaps in the second half of next year, because they've taken encouragement from the fact that some of those headline inflation pressures are going to really be moving in the right direction. They're also looking at some of the international markets where, in the US, for example, markets have tended to begin to think that the Federal Reserve Bank, the Federal Reserve is done with increasing interest rates there and might be turning around to cut rates next year also. I'll be looking at our view after we hear what the Reserve Bank's got to say about the medium-term inflation outlook next week to think about what we do there. But I think it's fair to say that it's still reasonable to expect that interest rates around 5.5% are here to stay for a good while yet, because they need to see that progress in core inflation pressures before they can have that confidence in cutting rates. And I think even after that, you're probably going to see a relatively modest cutting cycle. It'll probably go maybe 25 points a quarter for a while, in step with how the data goes on those inflation pressures. So there's a bit of hope there, I think, for people if they're looking forward a year or so that there could be some lower rates, but perhaps not in the next 3 or 6 months. The other thing that's going on is we've got a new government coming, presumably. One of the things about we've got a centre-right government coming, and that does tend to be associated with periods of optimism in the business sector. We've seen that in some of the most recent surveys that have come out. So I guess the key thing for the outlook will be to see to what extent does that optimism ultimately be reflected in better activity in the business sector, whether that be investment and employment, etc. To the extent to which that holds, then maybe that growth outlook we've got here could actually hold up quite well. We'll just have to see. We obviously don't really know what the policies of this new government are exactly going to be yet. But nevertheless, we have a fairly good guide that, typically in right-leaning governments, you end up with the government being a smaller share of the economy through those periods. And certainly the preview forecasts, our forecasts are kind of consistent with that, this idea that the government should be getting relatively smaller over the next few years. We'll learn more as we get through to Christmas and the high FU and the new government to work out, how fast that government size is going to fall relative to the economy, and ultimately to the extent to which that occurs, that will actually help restrain inflation pressures in its own right, because there'll be less demand coming into the economy from the government sector. We anticipate that the government's going to be running deficits for a good few years yet. Our view on the deficit is actually a bit more pessimistic than Treasury's. We kind of anticipate that we might be looking at deficits all the way out through to 2027, which is not great. The reality is the deficit this year and next year, those are probably largely baked in, but it'll be interesting to see what the new government policies say about, for example, government spending, and whether there might be some medium-term improvement come out of that. Although our sense is that we're not going to get too much out of that. I don't think this picture is going to change terribly at all, unless something happens to gee up the level of economic growth through that period. So what do we think they're arguing about? It's taken them a little while to get this deal done. From a macroeconomic perspective, we certainly see quite strong commonality in the policy positions between these three parties, which means that the deal will be done. But there are some differences at the margin, particularly with respect to New Zealand First, which has a few policies in their manifesto which we suspect at least one of them is going to want to be funded, perhaps around aged care or rates rebates for senior citizens, increased health spending, some infrastructure spending. These are all things that are probably sitting there in the mix, and I'd say that Winston and his team will want at least one of these things to show to their voters that they've achieved something from going into this coalition. The other thing that's kind of like circulating around there is how National's going to pay for its tax cuts. Obviously there was a lot of chat around the foreign buyers tax, which was supposed to generate quite a bit of revenue for them over the next few years. Seemed quite optimistic. We didn't do any costing ourselves. It sounds like a source of discussion within New Zealand First with National is that they don't like this idea. And as a result, if National wants to have these tax cuts, they're going to have to find that money from somewhere else to pay for it. Probably means a few more cuts or some reprioritisation of other spending. Most of that would probably tend to be a bit more contractionary relative to the sort of picture that everybody was campaigning on beforehand. So hopefully we'll learn something maybe today, certainly before Christmas, in terms of exactly what everybody has signed up to. I guess the thing that we think is probably quite likely to happen here is a lot of those kind of housing-friendly initiatives they campaigned on probably go through, things like the interest deductibility for residential housing investors, the adjustments to the bright line capital gains tests. These are things that are going to make it more attractive for investors to be involved in the market relative to the last few years where they have been totally absent. And the other thing I would suggest is that there's a very strong incentive for the new government to go for growth here. So to the extent to which that there are changes in regulations that could be made that might encourage activity in certain sectors of the economy, and I know the agricultural sector in particular is one of those sectors that National was campaigning on, I can't see why they wouldn't go for that, because the easiest way to get yourself out of a deficit is to try to grow your way out of it as opposed to cut your way out of it. So risks, plenty of those. The sort of distribution of where we think interest rates will be in a year or so's time are very firmly centred on where interest rates are now. So that's why you sort of see that very peaked sort of distribution around here. Probably at the margin there's been a bit of a shift to the downside in terms of the upside risks that we were seeing for interest rates. Principally because the economy is actually coming off at a reasonable pace now, so that excess capacity is gradually being built up. But on the risks on the other side, there are still those upside risks there. Think about that housing market chart I showed you. Plenty of uncertainty there about what's going to happen there. And if that housing market does end up doing more like a 10 or 15% rise next year, that will be reflected in stronger consumption and investment. That will have implications for the inflation outlook and ultimately the interest rate outlook. But on the downside, I also showed you that picture about China, and things don't look flash there. There's not a high degree of visibility on what's going to happen. There's plenty of potential there for further downside for our primary sector and our exporters if that economy doesn't come through as well as what might be currently assumed. The other thing that we have to kind of keep in mind also is that interest rate chart, where basically there's still quite a lot of extra cost to go through into household budgets, and we really need to see, well, are those costs already anticipated by households, and as a result, do they already adjust their spending behaviour, or do we have another down leg to come? So we'll be watching the data pretty closely to talk about that. So with that in mind, I'll flick on to my colleague Imre, who's got the next poll.
Yeah, question on your predictions on the exchange rate. I'll just give that a few minutes to see how they come in. My job, I look after the market research, so I take on board all the good stuff that Kelly and team does and talks about, and try to weave that into where different financial markets we think are heading. Yeah, kind of fairly balanced. A tilt to the bulls, the Kiwi dollar bulls. Oh, geez, it's closing up. Oh my word. This is a great market. This is the kind of market you want to see. It's roughly balanced. If it was overwhelmingly one way or the other, that's a big alarm bell. You want to run in the other direction. So it's certainly not a crowded view. This is very good. For what it's worth, our view is that the top one, but I absolutely respect both of them. And the other two centres we've had, it's about a 60-40 mix in favour of the bullish Kiwi dollar view. Yeah. Oh, yeah. That's fantastic. So I guess what we're saying is it could go up, could go down, and for that they pay me decent money to come up with that stuff. Okay. Okay, so I've got to come up with something. I can't just sit on the fence, and I have said that we're probably going to go up. Not a lot, but we're going to go up. That's the broad direction of travel against the US, against the Aussie dollar, other direction. And for interest rates, down moderately. And for yield curve shape, that is the difference between a short-term interest rate and a long one, we think it's going to move towards a positive slope. I said that last time around, and this is increasingly becoming one of our strongest market trading views, that we will get a steeper yield curve. But I'll substantiate all of this in brief, starting with the Kiwi US. So there's the picture of recent travel. You can see Kiwi has trended lower for some time. It's found a bottom of sorts. There'll be some budding chartists in the audience, no doubt, who will look at this very recent picture and say, gee, that's a good little bullish signal, I'll buy on that. I would too, but there's more to it than just that. But while we're on this chart, you can see, well, you know, how high would you be heading if you are indeed rebounding off that 58 area? I think somewhere north of 61 towards 62, I think would be a fair target as a multi-week, perhaps, 2 months out sort of thing. This has also got implications for people who aren't just currency punters. So, many of you will be hedging export receipts, for example, and the questions you'll always be asking is, where should I be loading up more hedging than normal? And my answer to that would be, right now, if you saw that sort of 58 to 59 area, that would be a pretty good area to load up on your foreign currency sales, Kiwi dollar purchases, if you see that. But as I say, I think we're going to trend towards that 62, and further ahead you'll see in the longer term economic forecasts, we've got a higher Kiwi right through next year. So that is the direction of travel we think for some time to come. What's behind all of this? Mostly the US dollar. So whatever the US dollar does, the Kiwi US does the opposite. That's the general rule of thumb. It's always been that way. Sometimes that relationship is stronger than normal. Right now is one of those times. Indeed, about the last year, it's been one of those times. So that relationship is acutely stronger than normal. You can see in the recent run-up over about the last year, the US dollar has appreciated quite a bit. What's been behind that? Expectations of US economic exceptionalism. So US economic growth rebounded. The numbers, after people had written off the US and said, gee, they're heading into a recession, the numbers started to look surprisingly strong. And for a while there, people thought, gee, we were wrong about this recession, it's never going to happen, and the US is an exceptional country, and it's going to go to the moon, and everyone flew into the US dollar. So that was the rise behind the US dollar there. Lately, for about the last 6 weeks or so, the economic data in the US has cooled down. Now, it hasn't fallen out of bed, but it no longer paints US exceptionalism. And without that, the money has given up on the US dollar to some extent and flown out into other places. So that is why the US dollar has started to come off, and that is why the Kiwi US has risen. We think that story behind the US will continue right through next year. So that really is the basis for our Kiwi US forecast. For the rest of this year and all of next year, we think US economic outperformance is something of the past. So yes, it might keep pace with other countries, but you don't have that extra bit to attract money into the US dollar. Other things going on, of course, that drive the Kiwi US, things like interest rates, commodity prices. Commodity prices have trended lower until very recently. For about the last month, we've had some pretty good results on the in the dairy auctions as one example. So having a little bit of a rebound, but this is not as big a driver of the exchange rate as it has been in the past. Indeed, if you look at all of the things that usually drive the exchange rate and try to model them, things like interest rates, risk sentiment, equity prices, economic growth, throw them into a model, you get the red line. You can see it's a reasonably good model. It has actually come off, so fair value is falling. The actual exchange rate has fallen even faster than fair value, and we're at a state now where we're undervalued relative to where it should be according to those things that drive it, by about 3 cents. So we see fair value right now is between 63 and 64 cents. We can use this fair value to answer 2 questions. Why has fair value fallen? And what do we expect going forward? So the first one, why has fair value fallen? We can unbundle and go under the hood of our model, using a bit of stats, and see that the number one component which contributes to the movement of the Kiwi US over the period of January to October, so that's that big rise that you saw in the US and the big fall in Kiwi US, the big contribution is the US dollar by a long way. You can see all the other things are tiny, they're trivial. So really not much else has mattered other than whatever the US dollar is doing. So that being the case, and we think this will be the case for some time, the sensitivity to the US dollar is going to remain intact, certainly for the next quarter. If you believe that the US economy will continue to cool a bit, we think the lustre will go off the US dollar and we will go up as a Kiwi US exchange rate. On to Kiwi Aussie, which is the second most important exchange rate in terms of volume in New Zealand. Last time around, we thought the cross would roughly go sideways, and it kind of did. It fluctuated up and down. There was no directionality. For the quarter ahead, we think lower. And the reason for that is mostly to do with relative interest rates. And there's a very interesting story playing out now, whereby the RBA and the RBNZ are behaving differently compared to the usual. The RBNZ was one of the first in the world to start hiking rates, and it was one of the most aggressive. The RBA was one of the slowest, and it's now playing catch up. So we're in a state now where, yes, the RBNZ might have one more hike in it, maybe not. RBA probably does. So they're playing catch up. So what's happening is the difference between New Zealand rates and Aussie rates is shrinking. So we're falling, Aussie rates are starting to rise a bit, and you're getting this yield gap actually closing. You can see that red line there has fallen quite sharply over the last couple of months for exactly that reason. Now, when the interest rate appeal of the New Zealand dollar relative to the Aussie goes down, the Kiwi-Aussie cross falls, usually. But you see it hasn't. So I think there's potential there for a catch-up. In other words, it's fallen behind its one notion of fair value, if you like. So that's one reason why I think in the short term, Kiwi-Aussie has potential to fall further. A much longer term view would be to do with more economically fundamental things like the terms of trade. Australian terms of trade has been fantastic, likely to continue being so. New Zealand's okay, but just that superior Australia in terms of trade performance means that over the long run, its currency should be much stronger than New Zealand's and should do a lot better. So we're thinking kind of 1 to 2 years ahead. Okay, that's on exchange rates. On to interest rates and breaking them out into short and long-term ones. A short-term one, such as the 2-year swap rate. Last time around, we thought sideways within a range. It did actually go a little bit higher than I would have expected and threatened to break even higher outside that band. But then it's come back in lately. So looking ahead for the next quarter, I think that we have seen the peak in the 2-year swap rate. And this would apply to pretty much all short-term interest rates, whether it's a 1-year rate or a 3-year rate. I think we've seen the cycle peak in these interest rates, and there's going to be plenty of volatility, and I'll tell you in a minute why, but that, for example, the 2-year swap rate peaked at 5.87. I don't think we'll see that again in this cycle, and I think over the next quarter we'll see something in the high 4s probably. Now, what's happened? Market psychology has flipped. Now, this is a picture of the black line there showing market predictions for the OCR. It's via a traded market called the OAS market, and you can put bets on what do you think the Reserve Bank OCR rate's going to be at future meeting dates. And it's a very good indicator of where the market thinks the OCR will be at various meetings over the next 2 years. Now, when I showed this picture 3 months ago, the black line was very close to the forecasts that were given by the Reserve Bank, which is the blue one, and by Kelly and his team, which is the red one. They're all pretty much in line. There was some chance, everybody thought, of another rate hike, and then only a very gentle rollover. In other words, the cash rate was going to stay here for quite a long time. That black line tells you that the market believes no chance of any more rate hikes, and we're going to have rate cuts starting in the not too distant future. Indeed, they've got a 50% chance of a May cut in there. Okay, now you wouldn't argue with the markets being highly preemptive as they always are, because that's how they put their bets on and make money. But to actually price in a May rate cut, we think is going a bit too far. Now the markets do this because they're so preemptive. They want to be first in, put the big bets on, so they tend to over-rush in the initial phases of a new move, and I think that's exactly what's going on here. So we would think that it's probably overdone for now, and it does need a bit of a correction, which is the volatility that I'm talking about. You're going to get bouts of this where the news doesn't conform to the bets that have been put on, and so you get a bit of a rebound in short rates, and then a new wave of pushing rates lower commences again, and it just goes on and on and on. But the trend, I think, will be downwards because the market psychology has changed now to thinking these tightening cycles, not just here but around the world, are done and dusted, and let's look ahead to the next big thing, which is falling interest rates. That is the direction that most of the bets are being put on. And even if they're not speculative bets, bond investors are thinking the same way. They want to buy lots of bonds and be positioned well before the rate cutting cycle starts. So that is going to be the direction of travel, which is why I think the trend will be lower in interest rates from here. Initially, it's not going to be as fast as the fall we've seen over the last few weeks. So I think over the next couple of weeks, you'll probably have a bit of a rebound. Rates might go up 20, 30 points, and then they'll move down again, as I say. So, you know, the net fall from here to, say, 3 months out might only be another 20 basis points because they've got plenty priced in for cuts already. It's not a unique thing to New Zealand. This is happening all around the world. This picture shows you the peak expected cash rate for various major countries. And you can see that expectations of the peak have peaked. They've started to come off. Markets are thinking we're not going to get to those highs. It's going to be something lower. And again, this same psychology I mentioned is gripping a lot of international markets. So they're starting to depress their expectations of central bank rates for the future. The one odd man out, if you like, is that green line. You can see that's the RBA. As I said, they're behind the cycle compared to most other central banks. They've got more hiking to do, probably, so the market's going to treat them differently. And finally, on long-term interest rates, all of the short-term interest rate arguments apply with one extra one, and that is that, yes, while I say all rates will fall, I think the long-term rates will fall by less. And this is going to help the curve steepening view that I talked about. And that is because long-term rates are driven by not just monetary policy expectations, but also by bond yields around the world. And they are being driven partly by fiscal matters. Fiscal matters are becoming quite a big thing lately, particularly in the US, somewhat in New Zealand. Markets are latched onto the idea that governments are actually borrowing lots more money than they have previously, and they're borrowing that through bond issuance. So if you issue lots and lots of bonds, all else equal, the yields have to rise. At the same time, you're going to have this cutting cycle, so that'll drag the rate lower, but the long-end yields won't fall as fast as those short-term yields. So you're going to end up with a steeper curve, and these fiscal matters, I think, are going to be a part offset to this pricing of easing cycles for the future.